Yo, what's up guys? Welcome back to This Just In. Thank you for joining me today. In this video, we're going to take a look at APPS stock, that's Digital Turbine. Wanted to give you my thoughts on their most recent earnings report. The stock got absolutely crushed. I didn't think the earnings were that bad, so I wanted to kind of break them down and kind of give you an idea of where I see the stock going for the remainder of the year. So let's jump right in. All right, guys, before we get started today, subscribe to the channel for me. Remember to hit the little bell so you get notified every time I post. We've had a lot of stocks in the videos doing really well, so you don't want to miss that. There's also a link down in the top pinned comment to my Patreon account. Come over and join the family. We've got an awesome community over there. You'll get access to the private Discord where we talk stocks. You can check out my portfolio anytime I buy or sell a stock. That's also going to be with like my high conviction, long-term fundamental analysis plays. I'll send it out, take screenshots of the income statements, the cash flow statements, so you know exactly what I'm looking at. Most valuable though is absolutely the swing trade setups that I send out. We have had a ton of winners lately. That way they're super educational, so you can learn to identify what we look for, where to place your stop losses, where to take profit. You can also make money. So then there's a lot of education over there as well, other than just the charts that I send out, like books and graphs and things like that you can use to just become a much better investor overall. So if that's something you're interested in, definitely come over and check it out. You don't want to miss it. We do have a few more spots left down on that $10 tier. That isn't going to, last very much longer. I think there's like 10 or 15 spots left. But the price has gone up. It's going to stay this way for, quite some time. I don't see me raising it anytime in the future, but definitely take advantage of that. It's hands down the best way to support the channel. If I've helped you make any money, or if you just want to support the community, be part of a family, come check it out. Day One Squad, I love you guys. Thank you for your support. But guys, let's jump in today. Real quick before we go, down in the description, there is my Instagram and Twitter link. In the last couple of videos, though, I had my personal Instagram in there. So make sure you go and follow the channel's Instagram, because that's where I'm going to be posting all of the stock alerts and charts and, just educational type stuff. So if you want to see, more frequent posting or stay up to date with me, on a closer basis other than the Discord or the Patreon, definitely go follow the Instagram. I would really appreciate it. Hit the Twitter too. That way I can build my followers up and look cool for all my friends. But guys, let's get started. I want to talk about APPS stock. That's Digital Turbine. For those of you guys that are new to the channel, APPS has been one of my favorite stocks for a long time. I've been watching that thing since it was like low teens, and I've watched it run all the way to almost $100 a share, and it fall all the way back in mid-August, and it finally found its bottom and started to move back up. I did send a trade setup out on this, when it was breaking back above the inflection point a few weeks back, and we've done really well. We hit the first target, the second target, and then earnings came out and we had that big dump. So I want to look at the earnings report, and I want to see, why did it dump like that? Like, is that sell-off justified, or was it a massive overreaction like we see all the time in the market? So I still like Digital Turbine overall, but let's get down to the nitty gritty. We'll also look at the discounted free cash flow model to kind of get an idea of what the intrinsic value should look like today, what the growth rates are, make some assumptions. Then I'll break down the chart for you and let you know where I think the optimal entry points are and where you should be taking profits. So let's get started. First thing, guys, this is the earnings report here. As you can see, this was back on November 2nd, so this was a couple of days ago. Digital Turbine falls 7% alongside narrow revenue beat and strong revenue guidance. Guys, the stock has got absolutely annihilated. It was sitting at like $91. They dropped earnings, and it literally opened the next day at like $70. So that's a massive, $20 dump right there within a matter of days. The stock can be very volatile. I mean, from October of last year, like I said, it was like in the low teens, $20, and then it ran to 100 over a couple of months. So very volatile stock. It can make some big moves. So you definitely want to be careful. You don't want to be buying it at the all-time highs. You want to find those strategic entries. I want to say something real quick though before we move on. Guys, I know a lot of people are, kind of fixated on this long-term investing, or, I dollar cost average, things like that. Everybody is a trader at some magnitude, right? It doesn't matter if you're buying and day trading or if you are buying for the long term. If you're buying for 3, 4, 5 years, it doesn't matter. You're still essentially trading because you're still trying to time the market. You're not just buying a stock at any point thinking that it's going to go down. You're buying it because you think it's going to go up. Now, whether that be going up in a month or a year, it doesn't really matter. You're still looking to buy low and sell high. The reason why I say that, guys, is because looking at charts, technical analysis is hands down one of the most important aspects of investing and trading. Because yes, you can go through fundamentals, you can see where the company lies as far as PE ratios, valuation metrics, free cash flow statements, things like that. But if you just buy it at any point because it looks a little undervalued, but it's sitting right at a major resistance level and the next support is 20% lower than that, then you're going to get wrecked. And you may buy at the top, it may fall all the way down, and then you've got to wait until it goes all the way down and all the way back up. Yes, you can average down, but you're sitting there buying into a losing position at that point, hoping and waiting for it to turn around. So you need to supplement technicals with fundamentals. I know that a lot of people aren't a fan of using fundamental analysis matched with technical analysis. And I agree with that to a certain extent, because if you're trying to swing trade or day trade and you're so hooked on the fundamentals of a company, when the stock starts, breaking support levels and falling, you can sometimes, let those fundamentals cloud your judgment and be like, oh, but it's such a good company, I don't want to sell it here. Well, fundamentals and, stock price don't always align. So I don't think that you should be swing trading with fundamentals in mind. I think you should be more looking, if you're saying, okay, I want to hold this for, a year, 2 years, whatever it is, then you should absolutely be looking at the chart for optimal entry points, versus just buying it at any level. Now, with that being said, if you're swing trading, a week, 2 weeks, 3 weeks, and you've got a set trading plan of like, I'm going to get in here, I'm going to have a stop loss, I'm going to have a 3-to-1 risk reward. That's a different story. I don't even look at fundamentals on most of the stocks that I swing trade. Most of the time, I don't even know their names. I just know the ticker price. I find them when I'm scanning. They look good. They present the opportunity, and I take the trade. So I just wanted to throw that out there, guys, because some people that are long-term investors are like super against technical analysis. They just think it's more of like, astrology or something. I don't know, but everybody's a trader in, one form or another. So I highly recommend learning how to identify strategic levels on a chart to optimize your entry points. So with that being said, let's get started on the earnings. As you guys can see here, it did fall 7.3% in after hours following the fiscal second quarter report, where revenues were more than quadrupled, but just edged analyst estimates, and the company guided to the high side on revenues for the current quarter. Revenues rose 338% to $310.2 million as reported. They were up 63% on a pro forma basis. This is the first quarter that the company has, reported earnings as all of their acquisitions wrapped into one entity. So that's something you definitely want to keep in mind. Guys, I don't know if you read that like I read that, but as you can see, they grew their revenue by 338% year over year, almost quadrupled it. However, though, they barely missed, or they edged against what the guidance was. So the analysts on Wall Street were guiding for them to do a certain amount. Even though they almost quadrupled it, it was real close to what they were guiding. And so Wall Street must not have liked that, or investors must not have liked that, and made the stock, sell off. As you can see here, guys, the non-GAAP net income rose to $45.3 million from $14.5 million a year ago. Adjusted EBITDA jumped 191% to $479 million. This is kind of a statement from the CEO. He said, our first full quarter reporting as a consolidated entity provided early evidence of the financial benefits from our greater scope and scale. That was from the CEO, Bill Stone. He also said, meanwhile, we are now strategically positioning the company for continued success in the future with a fully differentiated end-to-end platform. So guys, one thing I want to point out here. Those two acquisitions they just made were very strategic, and I think it is setting them up to do very, very well. Obviously, that is some explosive revenue growth. Not only are they growing their top line, but they're also growing their bottom line. The net income is coming up. They are one of the best companies in their industry. I mean, they are a beast of a company when it comes to competition, and there's not a lot of competition in their specific industry or niche. I've made other videos where I go much further in depth on what the company actually does, and I will link that right here above if you want to go check that out. But one thing I want you to keep in mind, Single Tap, one of their services, their main service that they started with, is now installed on over 700 million Androids worldwide, which is only 20% of all Androids, guys. So they have a huge way to grow, just within those Android devices. The other thing is the ad colony, the acquisitions that they made is giving them a much better, suite of offerings. They're increasing what they can offer their clients by a tenfold, not only on publishers, but also on advertisers, which is inevitable to grow revenue if you can offer a better product that offers more services and gives you better results. Obviously, your customers are going to appreciate that. So they give a lot of room for growth over the course of the next 5-10 years when you start looking at, their current market capitalization, how much market share they currently own, and how quickly they're growing. Obviously, that isn't sustainable forever, right? They're going to hit that point and diminish, but I think we're at least 3 to 4 years off, 3 to 5 years off, honestly, of hitting that point of diminish where growth drastically cuts in half. I don't think that they're going to grow at 338% quarter over quarter forever, obviously, but I do think for the next 3 years, you're going to see explosive growth before you really see it start to die off and, get down to those like more steady levels. Now, as far as their guidance goes, you can see here, they are guiding to do revenues of about 350 million to 355 million, which is above expectations for 340.7 million. And it's in line with the EPS of about 41 to 44 cents per share. So they are guiding to do a little bit better than the top line of what they were expected to do. Who knows? They could end up doing even a little bit better. We'll just kind of have to wait and see. But with the growth that they've been putting out, it's pretty insane, guys, how rapidly they are expanding their revenue and their bottom line. Let's go ahead and jump over to the fundamental analysis discounted free cash flow model so I can kind of give you my idea of what the intrinsic value is. One thing I want to point out on this sheet, guys, I really love this sheet because it's a simplified version of a discounted free cash flow model. I like this sheet because not only can you put assumptions in, but you can kind of play around with, your idea of what you think they're going to do. So you can say, okay, I assume that they're going to grow at 30% for the next 5 years and then 5% a year after that, or whatever it is. As you can see here, I put in all the metrics that they've got. So I put in, and this is trailing 12 months. Their 2020 revenue was a little bit different than their trailing 12 months by a pretty big margin. I want to say they did like 350 million in full year 2020. They're currently sitting at 706 million in their trailing 12 months, but their free cash flow was lower in their trailing 12 months than full year 2020. So just wanted to throw that out there. As you guys can see here, most recent revenue, net income, free cash flow. Now the growth rate that I put in, guys, I only put in 35% year over year for the next 5 years. They are growing substantially faster than that. I want to say their year over year growth is like 240% overall. And I want to say that their 4 or 5 year growth rate is about the same, well over 100% year over year for the last 4 or 5 years. So putting it 35%, in my opinion, is rather conservative. We could look at it, with about a 50%, 60%, whatever it is, but 35 seemed to me at a extremely, nice growth rate that is going to be very easy for them to achieve, even in the worst case scenarios. Next thing here is I put their, terminal growth rate at about 5%. So after 5 years, what they'll grow at year over year over year in perpetuity. Discounted at about 10%. As far as net income margin, I put 8%. That's exactly what they're doing now. And then their cash flow margin, I put about 17%, which again is pretty much what they're doing now. I do think that cash flow margin will go up, especially with those acquisitions really starting to be factored in, on a more long-term or full year basis rather than just that recent quarter. As you can see here, guys, I'm coming up with an intrinsic value per share at right around $78, which is a little bit higher than where it's currently sitting at, but it is quite a bit below where it was sitting at just a couple of days ago. One thing I will say is I did see some analysts that came out and actually upgraded it as a buy, and they assigned a price target upwards of like $95, which I think is very reasonable. If we change these numbers even a little bit, guys, like if we take this growth rate from 35% and we put it up to 45%, you can see that jumps the stock price to $110 just like that. So an additional 10% over the course of the next 5 years, from 35% to 45%, jumps the potential share price from $78 to $110. You could pull your cash flow, percentage down. You can do whatever you want. I think that the fair value for the stock, or the intrinsic value based off of what they're doing now, if they can continue to do it, is upwards of around $100. And I think that's going to continue to go up over the course of the next couple of years if they can continue to do what they've been doing. Last thing I want to kind of show you guys is if we pull the cash flow margin down to, about 12%, what they would need to do in as far as growth rate to get to like $90 to $100 a share. So 55% at about 12% cash flow margin, $107 per share for the intrinsic value, based off of what they're currently doing in the trailing 12 months. So with that being said, guys, my Digital Turbine stock price prediction is right around $100, 95 to 100 over the course of the next year. And I do think that it can eventually go higher than that. It could even go higher than that in the next year. But with that being said, let's go ahead and jump over and look at the chart and kind of take a look at where we should enter. All right, guys, so we've looked at this chart before. I actually covered this stock in the video I made, about a week or so ago, on some of the best swing trade setups to buy now. Actually, I was just doing an update on this one. This one wasn't one of the actual swing trades, but nonetheless, I haven't made an actual video on this company for quite some time, at least a few months, but overall, we've kind of looked at the chart, especially if you're a member of the squad. Guys, really beautiful looking chart. I mean, if you take a look since the COVID crash, undeniable uptrend, right? And that's the stock you want to trade. You want to trade an outperformer. This stock has absolutely been outperforming. It's even outperformed the market even with the big dump. As you can see back at COVID crash, you could have bought this stock for literally $4, which is absolutely insane to me. Like I said, I've been watching it since like low teens, early 20s, something like that. But you guys can see, ran all the way up, hit the high point back in early March, up there at $95. Before drawing down with the rest of the market, especially the high multiple growth stocks. They all got beat down pretty good, but this one didn't do as bad. Definitely going from 95 all the way down to a low point of like 46. That's losing like 50% of your value. If you take from the high to the low, yeah, it lost 53% of its value. We recognized that. We saw that it broke critical support, broke the inflection zone, and then started to, to make its way back up. Guys, we had the reciprocal ABCD pattern, which is a bullish pattern. We watched it, put it on the watch list. As soon as it started to break and broke the inflection zone and started back testing it, we sent out the trade setup as a great opportunity because, guys, like I said in the last video, this is where you want to take trade setups at the low risk value areas, because when you take a trade, when it's back testing an inflection zone like this, you set your stop loss marginally under the inflection zone. And because there was a gap right here, I set it a little bit below the inflection zone. But as you can see, still a minimum of 4 to 1 risk reward on the first target. Let me rephrase that. We want at least a minimum of 3 to 1 on any trade for the first target. But this one was a 4 to 1, even with a honestly looser stop loss than you probably could have used, but nonetheless, still beautiful trade. Again, tested the inflection zone for a couple of days, broke the supply line that was manufactured back in March at the all-time high, then ran up, back tested the 200-day moving average. It was acting as resistance, for the prior weeks. Once it back tested that 200-day moving average, which was also confluent with these highs from back here in January, and a lot of these wick lows, while it was up there testing in the all-time highs, it just took off, hit the first target shortly after, went all the way up, hit the second target, which was, again, the candle high close, from back in February, as well as the all-time candle high close in March. So really, really strong asset, guys. Again, definitely an outperformer. One thing I want to point out, guys, we did have, as you can see here on the MACD, triple class A bearish divergence on the MACD. However, the relative strength index did not show that. When you're in a trade setup like this, guys, like for a short-term swing trade, you hit your first target, you want to pull your stop loss up. You hit your second target, you want to pull your stop loss up. Like, you don't want to just leave it all the way down and, lose all of those profits on the way back down. If you only get to the first target or halfway to the second target, whatever it is, you want to get into the money so that you can make sure that you're securing your profit. Now, with where it's at right now, guys, this is actually not too bad when you consider that this thing is up like 100% almost since back in like what, August, 102% since back here in the middle of August. That's not that bad. If we take our fibs from the discernible low to the high, it looks like, you know, we are right at the 50% retracement, which is also, again, retesting the 200-day moving average, as well as the 50, moving average, which is going to be your dynamic support resistance. It's also testing the wick high from back here in January, and then the wick lows again throughout the rest of the beginning of the year. If it holds here, guys, it could absolutely hold here, pivot and run again. Now, one thing I want to point out, you've got a higher high than the previous discernible swing high. You've got a higher low if it pivots there than the previous discernible swing low. So it's really not in bad shape because you're still in an uptrend. If it breaks this, inflection point and breaks the D point, that's really bad. You really don't even want to see it break that 70.51 level, which is that wick high. And I would even say you could go as low as that candle high close, which is like 67. You really don't want to break that because if you do, you're going to test 60 again. I mean, that's the next major level. And you definitely don't want to see it break the inflection zone down there at like 56 bucks. If it can pivot here, that would be ideal. However, you want to wait for strong follow through price action because it could pivot here, run up, create an attempted rally, make a lower high than the previous discernible high, and, turn around and bleed back off, back down to the inflection zone. So this isn't really the area to buy a stock right now if you do not own it, if you're not in a position. Now, if you're holding it for the long term, you want a dollar cost average, then yeah, testing the 200-day moving average is not necessarily that bad of a place. You dumped, you're resetting the oscillators. You could just be setting up to get another leg up and, run to much higher prices. I want to show you this because this is pretty funny, guys. This is a bearish shark pattern, which is pretty insane how close it came and then dumped. It didn't quite get to the 886. The 886 would be right around there, but you almost got there. I mean, you were maybe 2% off. And like I said in other videos, you can technically give harmonics a 3%, swing from, like, if the pattern completion zone is an 886, you can give it 3% on both sides. So you can go to like, 91% or, as low as 85%. I don't like to give it short. I like to give it a little bit long. Like, I won't give it the 3% if it doesn't make it to the 886. I don't like to do that. But as you can see here, that's why you can do that, because stuff still reacts right at those levels. Now, a shark pattern can go as deep as the 113% retrace, which would be clear up here, right around there. So about $100, which is, where I think the stock could absolutely be going. Now, this is still in play. This bearish shark pattern is still in play as long as this does not break the C point down here, which I think the inflection zone is strong enough that it should be able to hold those levels. Again, if it breaks it, you don't want anything to do with it. But it could pivot here, run up, hit the 113% retrace, which would be a new all-time high, back test, the next inflection zone, which is right there at the 95 to 92, and then run again. So, I don't think that Digital Turbine is in that bad of shape right now. Obviously, the dump is kind of a bummer, especially because it was going so well, but it's got to take a breath or it'll fall on its face. One thing I want to show you, and I think I showed you guys this in one of the videos I did a while back, this is really what we're playing, guys. I mean, this major structure on the weekly chart is really what I'm playing, at least, because I think this is absolutely where we could see it going, right up there around, $140. You've got a bearish AB equals CD pattern. It's fractal. I mean, patterns reoccur. You've got a smaller reciprocal ABCD pattern on the daily. This is really the structure you want to take a look at. Big rally, pull back to, almost a 60% retracement, and then it's starting to leg up. When you look at it on the weekly, that looks bad, but it isn't that bad. It really got rejected up here at the candle high closes, not necessarily just the wicks. So we just got to see what happens, but I think it's still in good shape. As you can see here on the weekly chart, you are starting to lose positive momentum. It is starting to kind of wane, but it could just start rebuilding and running again. You can see here, how many times has it started to wane and then start building again, starting to wane, start building again. So the RSI is sitting at 51.95. It could again bounce off that neutral zone, run back up to the bullish control zone. As far as the 3-day chart, same type of thing, guys. Starting to wane on your MACD. As far as your RSI, sitting right at 50, so you would want to see it turn around there. This stock actually started the day up a couple of percentage points. I mean, it was up like 2 or 3%, earlier today, and then turned around, started to dump, and, went back to test that level and the 200-day moving average. So you did have, some pretty serious, levels of negative momentum. Obviously, a vicious dump like that's going to cause that, but that's the highest level of negative momentum that you have seen on this asset since March. So that's pretty crazy, guys. As far as the relative strength index, though, goes, you're pretty far down. You're about 40 here. But how many times have you seen it, hit 40, turn around and keep moving? This is not the area, again, to buy it if you do not own it. Wait, it's not about the dump, guys. On the pen stock, the video I made the other day, that thing got absolutely destroyed today. It stopped me out of the trade, but whatever, that's trading. It's not about the dump. It's about the follow through price action. It dumped today. What we could see tomorrow is we could see a big bullish engulfing candle. We could see it just start running 3 white soldiers and take off. Or we could see it just continue to dump. So we just got to be patient and see where it's going to head. I love the stock. I still have it in my dollar cost average portfolio, still planning on adding to it every single week. But as far as my swing trade goes, I'm just kind of sitting there waiting to see what happens. I've taken profit. I'm, completely in the money. I have nothing to worry about. Anybody that took it with me in the Patreon, you have nothing to worry about. Just be patient. Let's see what happens. But that's it for today, guys. Thank you so much for watching. I really appreciate your support. This video is for entertainment purposes only. I'm not a licensed stockbroker. Always do your own research and due diligence. Don't just take my word for it. Come over and join me at the Patreon if you want to be part of an awesome family. Remember to follow me on Instagram and Twitter, and let me know down in the comments what you think about the video, and I'll see you guys in the next one. Peace.